Good morning. Good morning. And thank you all very much for joining us this morning. My name is Steve McMenamin. I'd like to welcome you to today's event, which is part of the continuing series of the Greenwich Roundtable. Our topic this morning, asset allocation for 2019, navigating the risks and charting the opportunity, is our annual symposia for the Chief Investment Officer. As a historical note, we started doing this session about 23 years ago in September, because in the old days we had to give 90 days notice to get our money back before the end of the year. And so the tradition continues. And I'd like to ask you, as a courtesy to our speakers, please fill out the backside of the invitation card so we can tell them how they've done. We've got three of the very best athletes playing a very competitive sport today, and all very different from one another. And before I introduce them, I'd like to say this: the speakers' views are their own and don't necessarily reflect our views. So with that, in alphabetical order, I'd like to introduce them. Ann Deneen is the Chief Investment Officer for Hamilton College Endowment. Before that, she was the Director of Investments for the James Irvine Foundation. And before that, a quantitative portfolio manager at Barclays Global. She's a trustee of the Wallace Foundation and a member of the Hotchkiss School Investment Committee. Sitting next to Ann, Chris Heisey is the Chief Investment Officer for U.S. Trust Company and Bank of America Investment Management. Before that, he was the Chief Investment Officer for Citigroup Private Bank in Latin America and head of Merrill Lynch's Investment Committee for International Private Clients. Sitting next to Chris, Ellen Schuman is the managing partner of Edge Hill Endowment Management, an outsourced CIO firm based in New Haven. Before that, she was the Chief Investment Officer of the Carnegie Corporation in New York, where she outperformed by exposing their portfolio to the emerging markets at the right time. Before Carnegie, she worked at the Yale Endowment. In 2008, she was a member of the Investors Committee of the President's Working Group on Financial Markets. And the moderator today is John Griswold. John is the chairman of the Greenwich Roundtable and the founder of the Endowment Institute, as well as the Common Fund Institute. All three are preeminent educational forums for not-for-profit investors. He's a prominent authority in not-for-profit governance, and we're lucky to have him navigate today's session. Please welcome John as he sets the table for us.
Thanks, Steve, and welcome everyone. In past years, of course, we've discussed asset allocation through the eyes of very talented, very skilled CIOs. Today, we're going to do the same thing, but give ourselves a little context to begin our discussion. Most of you remember, some of you quite a while ago, Finance 101. To define asset allocation basically involves defining the asset classes that constitute the portfolio and determining the proportion of the fund to be invested in each class. In so doing, the investor attempts to balance risk versus reward by adjusting the percentage of each asset in a portfolio according to the investor's investment beliefs, risk tolerance, performance goals, and time frame. That's a broad definition. We'll obviously become more familiar with how it's done in a few minutes. But as David Swenson at Yale put in his book, Pioneering Portfolio Management, thoughtful fiduciaries place asset allocation at the heart of the investment process, emphasizing policy portfolio decisions over market timing and security selection activities. Satisfaction of long-term goals depend in large part on the underpinnings of successful asset allocation, equity bias to provide high returns, and diversification to produce an acceptable level of risk. We obviously, that sounds fairly straightforward and simple. In fact, in reality, it's a devilishly tough job. We have many challenges to overcome in this process currently, many of which we've explored in the Greenwich Roundtable's due diligence publication over the last 15 plus years. Among those are behavioral biases of staffs and committees, governance issues, complexity of portfolios, complexity of the markets, low prospective returns in most asset classes, possibility of a downturn, crowded trades leading to fully or overvalued market segments, historically low interest rates, and last but not least in this list, geopolitical uncertainties. So let's let our experts begin to talk about some of the challenges and how they're dealing with this issue to give us a little more granularity in the discussion. Chris, why don't you start us off from your point of view?
Sure. Thank you, everyone. So I'm going to start off by saying I work in a pretty large company, and there's no short of economists and strategists at our company, whether it's Merrill Lynch, U.S. Trust, Bank of America, and all the other siblings. I woke up this morning and a flood of emails that said, "How do you square this one?" My good friend on the sell side, Michael Hartnett, who's one of the more articulate global strategists, wrote a report. The great bull market is dead. It's on CNBC's website today. My report for my team, which is about to come out next week, is the 100-year bull market. So how do you square those two things? How do you square the fact that Jeffrey Gundlach's talking about a 6% 10-year yield by 2020, end of 2020? How do you square the fact that Ray Dalio's, who is talking about a potential recession not until 2020? Bill Williamson about the global liquidity and the dollar shortage that is about to hit next year. How do you square all of these different inputs? And I'll premise my talk about, we think that there's two things that you should really, really pay attention to try to figure out how late in the cycle one is to help determine how to, if at all, adjust the asset allocation. And the first thing is the yield curve. And there's a lot of, I wouldn't call it misperceptions about the yield curve, because one's opinion is one's opinion. I mean, you can have a thought on anything you want. But what usually works and what has tended to work is not the 2 to 10 year spread, the 2 to 10 year yield spread. That has actually not been causal as it relates to a recession. And that's just not looking at quantitative work. That's actually looking at field-based study. The real spread in the yield curve to watch, to feel for whether or not we're mid, late, or the cycle's rolling over, and whether or not we're going to invert the yield curve, is the 3-month to 10-year. The 3-month to 10-year has a much more powerful probability to it from a quantitative perspective. But if you ask any treasury officer at a bank, which is really important to do, what's the spread you look at? It's that one. That's number one. Number two, they care more about the front end of the curve than they care about the back end of the curve because of the way the balance sheet works at banks, the net interest margins, et cetera, how the reserve system flows into a bank and out of a bank. So we spend most of our work looking at 3-month to 10-year, and that's about 80 basis points right now. 100 basis points is mid-cycle. So the front end, way in the front end, all the way to the 10-year, is telling us we're somewhere between mid and late cycle in the business cycle. Obviously, the 2s to 10s is very, very tight. It's 20 basis points, maybe 22, 23. And the concern in the market for those that are bearish is all centered around the 2s to 10 spread and how the fact that it's almost inverting. So here we go. Maybe 19, maybe 20, there's a recession. So I'll put that off to the side for a second. The other thing that's very concerning to people in the marketplace, the bear camp, is the fact that earnings growth is 20, 25%, depending on what quarter you're talking about in the U.S. And the U.S. is breaking away from the rest of the world for obvious reasons. But the bear camp is saying that we're peaking out in earnings. So we're going in a peak earnings cycle. Now, when you ask them to explain that, they talk about earnings growth. They don't talk about peak earnings in absolute terms, which generally is just around the time that the yield curve is about to invert. So they're actually confusing two signals out there. So the bear camp is focusing on a peak in earnings and the possible inversion soon of the 2 to 10-year spread. I would call the realistic camp is looking at a few things, and the realistic portion of what's going on is generally 5 to 6 C's. The first one is confidence. Small business confidence is either at a record high or close to a 2-decade high. That is absolutely critical, as you all know, to job growth. Job growth determines the next C, which is consumer spending, which is above trend right now and actually gaining steam. Best way to look at that is to look at the big box retailers. They are Amazoned, yes, they are, but they're actually doing very, very well right now. So consumer spending is the second C. The third one is CapEx. CapEx is at a 20%, 22% year-over-year clip. In the last 5 years, in the first quarter of the last 5 years, we had negative CapEx spending. This is the first year in 5 years we've had, and not only positive, it was 20% first quarter over last first quarter, and it's still gathering momentum. It doesn't last. As you all know, capital spending has a major cyclical component to it. So it'll be this year, possibly next year, where CapEx will be strong, but then it begins to kind of peter out. Once you spend on a new factory, you don't have to spend on another one. So you start to see that kind of roll over a little bit. But you've got consumer spending, you've got confidence, you've got CapEx. The fourth C is central banks. Although central banks are normalizing, they're going to normalize for years. And the fear in the marketplace is that they're going to normalize their balance sheet and their interest rate paradigm over the course of 2 to 3 years, and that simply can't happen. Without inflation being a major issue, central banks can allow the bonds on their balance sheet to mature on time. They don't have to sell them. If they sell them, this is where the big liquidity risk would be an issue. So the bear camp is expecting them to fast track normalization. The realistic camp is saying without inflation, the roll on their balance sheet can just go through its normal maturity, and you can go from a U.S. balance sheet of 4.3 or 3.9 or 3.8 today back down to somewhere around 2 trillion. We're not going to get back to 1 trillion or 900 billion, which is the typical level of the U.S. balance sheet. But certainly allowing over the next 4 years the normal cycle to mature, we'll get down below somewhere around 1.8 to 2 trillion. The ECB is not likely to raise rates at least until September of next year. The concern there is the fact that Draghi leaves office sometime mid next year. So the question is who takes his place. If they're ultra hawkish, that's an issue. But right now, that would be just a guess. In Japan, they will be going through balance sheet sterilization for the next 100 years. So all of that makes sense without a shock to inflation. Now, inflation was 2.9%. Sorry, average hourly earnings was 2.9% last Friday. It's the high since the global financial crisis. Our model suggests 3.5% for next year and 4% for 2020. 4% typically causes a central bank, the U.S. In particular, the Federal Reserve. The last 3 times we hit 4% average hourly earnings, the Fed not necessarily panicked, but they raised the Fed funds rate above the neutral rate, which inverted the curve, which created a recession. So we have to watch that very, very closely. The Jackson Hole speech is absolutely, they're always boring, but this one is slightly less boring because 3 times in the speech, Powell did say, I'd rather have the economy run hot than not. So that will tell us that if at any point we see any signs that this latest move up in average hourly earnings is starting to be static, he's going to pause. Bullard is a key vote on the committee. Bullard was around the last 2 times they made a mistake. So I would put the probability that there'd be more than likely a Fed pause than a Fed overcapitulation and raise rates a little too much. So central banks, the other C, are still accommodating despite the fact that they're tightening policy. And then last but not least, the 2 other C's, and I'll pass it on, is China. Obviously, the tariff skirmish or tariff war. We've got one in our shop that believe it's a war that's going to last forever, and another one says it's just a skirmish. So try to square that one. I think it's a little bit of both. I think it's clear that the U.S. is doing 2 things. We have a pretty sizable Washington policy team and one of the best geopolitical strategists out there, and I think might have been here before, is Dan Clifton. I strongly recommend his work at Strategis. And talk to Dan all the time, and Dan's belief is pretty simple. You go through a North American Free Trade Agreement renegotiation with the one country that you know you have a little bit more influence on, called Mexico. You bring Mexico into the fold. You get Canada to capitulate. Right now, the stickiness with the Canadians coming back into the North American Free Trade Agreement is coming down to soy and milk, believe it or not. So we'll get there. Once you get that area, then it switches. What do? You release the tariffs on European autos. Why? Because Europe has the largest trading partner. Who's who? China. You need Europe and the U.S. plus the North American Free Trade Agreement to make sure that China is the one that gets hurt in all this. So it's more of a bilateral tariff skirmish / war than it is a global trade war. And we expect this to kind of do one of two things, quite frankly. The U.S. ultimately capitulates themselves because they see growth coming down on the basis of this. We see zero signs of this right now. In fact, we don't even see input costs going up across the board. It's still early, but we'll be watching that very closely. Or you see China simply put a pretty sizable fiscal stimulus in place because their growth is dropping pretty aggressively below 6% right now. We think the latter is more likely than the former, and that would allow Premier Xi to negotiate and come to trade talks and ultimately look like there's capitulation from China's part, but not necessarily. So that will de-escalate things. That'll slow down the dollar, in our opinion, and that will ultimately kickstart reflation back into the emerging markets, which are not doing well, as you all have seen. So last but not least, what does this all mean? It means we are mid to late cycle. We're not at the end of the cycle, in our view. Fundamental earnings are still growing. Margins are hanging in there. Input costs are not rising yet. Average hourly earnings are feeding into consumer spending. The economy is growing close to 4%, and we're breaking away from the rest of the world. We do believe we're in a 100-year bull market. We had 50 years of it. Then we got hit in the head by an anvil called the global financial crisis. And now we're 10 years into the next 50 years, and it's simply driven by the demographics and the age structure around the world and what's likely to drive asset allocation in the next 50 years. So I'll stop there.
Good, Chris, thanks. That's a really good summary. Just one question before I turn it over to Ann. Is the employment number so low now that we're going to have to see some wage inflation? Will that ignite inflation itself?
The structural dynamics, so many factors that are keeping a lid on inflation. The first one is automation, as it relates to, we mentioned CapEx before, but automation, machine learning, predictive analytics, Internet of Things, you name it, is forcing price commoditization. So it's not feeding, average hourly earnings are not feeding into transaction costs, which ultimately feed into higher prices, which feeds into inflation. The second thing is the fact that those leaving the workforce right now are rolling off at a higher cost than those going in because of the sheer numbers that are retiring each day versus those that are coming in. And when you have a higher output cost versus a higher input lower input cost, the average hourly earning is very cyclical, so it's not sticky. So that shouldn't feed into structurally long-term inflation. Having said that, the next couple of years we'll see a tick up, yes.
Okay. Do you think the Fed will continue to slowly push rates higher, or do you think the pause is realistic?
I think the pause is very realistic. I think next week you'll see a hike, and I think the communication will be very, very, very balanced because I think they're not sure about December, but the dot plots should shift a little bit lower. The market's coming up to the plots. The whole shift of the curve should come down, not the yield curve, but the dot plot curve. As the realization takes hold that this is a little bit of fuel to the fire, and this is not an over long-term movement up. The deficit is an issue to feed potentially into inflation and a weaker dollar as well. So they're going to try to stay balanced, but December is the one to watch because there's still a possibility they pause there.
Thanks. Ann, tell us a little bit about your situation and how you manage this challenge.
Great. I think this is an interesting panel because we have probably a contrast here in terms of style. And I was speaking with Ellen before the panel today, and I think this sounds really exciting. And we were joking that what we do is actually quite boring. I have been prior to Hamilton College, I was with a foundation managing an endowment. And I was there for over 10 years, but for the last 4 years, I actually sat, it was based in San Francisco, but I sat in Manhattan with a very large family office called Moose Partners. And so while I was sitting with Moose, embedded in their team, seeing how they operated as a family office, but managing money for a very different, client, it was an interesting contrast to me in terms of how do you manage money as a family office? How do you manage money as an institution that would be an endowment where our time frame is perpetuity? So with that in mind, I would say, as I listen to you speak, the biggest difference for me would be, while we do not take a top-down approach to investing our endowment, it's very bottoms-up. And so we believe in a policy portfolio. And that comes from, at an educational institution, really my job is to preserve equity among generations. And the phrase is often that I'm the guardian of the future against the claims of the present. And so with that in mind, it requires being a long-term investor. As a long-term investor, I have to balance sort of maintaining the purchasing power of my endowment with the need to spend. We are a need-blind institution. I fund a significant portion of the school's operating budget. And so managing those two conflicting goals, what we have found is the way to sort of reduce that tension is to earn higher return. So with that, and when you think about that, I'd say philosophically, we have to take equity risk. We have to be very diversified. That is from a risk perspective to lower vol on the endowment, lower sort of the standard deviation of our NAV, because when you look at being a long-term investor, taking equity risk, maintaining that diversification, it all also has this overarching need for liquidity. I do have to fund the college, and so there has to be a total return component as well. And I think that's actually the hardest challenge with my job is managing the liquidity side. And we do not do capital campaigns to have infusions into the endowment. It really is a closed-end pool. I have to be fully invested at all times. And so the portfolio management aspect of my job, I spend a lot of time at that. And again, it is more bottoms up than top down. We target about an 8.5% return, and that comes from, I pay out about 5% of the endowment a year to fund the college. And when you tack on inflation, which is higher for educational institutions, it averages more around 3% than 2%. And I'd like to grow the endowment into perpetuity. I have to have that 8.5% hurdle. And that's hard. I think everyone in the room knows today that long-term capital market assumptions have come down. It is a lower returning world. And so to hit that hurdle, we're finding that's hard, staying within sort of the risk parameter that we target. I'd say I basically look at I have three levers I can work with. First would be asset allocation. Second would be that market timing component. And the third would be security selection. We spend the most time on asset allocation. We think that is really the critical means to express our risk return preferences, and that short-term anomalies, they do disappear into long-term trends or patterns. And so with that, again, we're not top down, we're bottoms up with that long-term asset allocation always in view. There's also a sort of not strict, but we do believe in rebalancing. We set our asset allocation by saying, I basically say to the committee, these are the different risk profiles we could have. And what are we comfortable with as an institution? What's the drawdown we're comfortable with? What are we comfortable with in terms of not hitting the return that maintains our value into perpetuity? Just we have, I'd say, really thorough discussions on what is the risk profile of the college? What are we comfortable with? And then my job is to optimize around that risk level through the asset allocation and executing on that asset allocation. I think that it's constant rebalancing, it's hard. In a 10-year bull market, you feel like you are taking chips off the table and the market keeps going up. On the flip side, when the market goes down and you have to keep adding to equities as they fall, you always wonder, am I catching a falling knife? But you have to say philosophically, how have we built this endowment? What do we believe in? And while it might hurt in the short term, we believe that in the long term, if we stick to that policy portfolio, it will help us weather bubbles and weather busts. And so it requires a strong stomach, it requires staying power. But as an institution, we have agreed that that's the bet we're taking. And so I think prior to downturns or prior to big bull markets, just knowing your institution, knowing who your client is, and how you can weather the markets, which are cyclical, I think that helps us sort of ground us in sticking to our knitting, knowing what we're good at, and not getting distracted. And so I think it's a little more boring, in that we are not as involved in the macro and what's going on in the market day to day, month to month. That said, I do think that investing is more of an art than a science. And so with our policy portfolio, we do operate in bands. And so there is a bit of that market timing component in that we operate within bands, but that's definitely a second priority to our long-term asset allocation and our policy portfolio and the pain that is required to continually rebalance. I'd say the biggest sort of pushback I would get from my committee with those tactical tilts is that oftentimes when you are riding equities higher, it really is crowding out, it crowds out the less risky assets. And then that by nature is increasing the risk profile of the endowment. On the flip side, we actually as a committee have been thinking about where we are in the market and is it wise right now to be raising cash, taking some risk off the table. But you also have to be cognizant of that's lowering the risk profile of the endowment. That lowers the long-term return profile of the endowment. And are we comfortable with that? And so I think those are challenges right now that most endowments are facing, that balancing of your long-term asset allocation with where are you today in the market, what's prudent. And I do think it is more of an art than a science. I came from, prior to being in endowment management, I was a quantitative portfolio manager. That's a science. There's no art involved. It's rules-based. It's factor-based. It's a science. And so given I spent that time in sort of formative years as an investor, I probably operate more along those lines. But I do realize the value of, making those small judgment calls in the context of the overall market and how it can add alpha. The argument against just sticking to your policy portfolio is many institutions can have the exact same asset allocation and have very different results. So it does depend on that sort of market timing and security selection tool as well. I think if I said, between those three tools, what do I prioritize? It's the asset allocation. Number 2 would be security selection. I spend a lot of time on managers and making sure that we're playing with the right people. And I think it's also just after you do it for a number of years and you've met with hundreds of managers, you get a little bit better at saying, I think maybe this group is better than average and this group's below average. And if you try to just play even a little bit above average over time, you'll have above average returns. But it's a hard game. It's a very hard game, but managers also they make their own tactical tilts. They make their own calls on market timing. And so while I might not be doing it as much at the endowment level, it's happening in the endowment on the manager level. And so I'm always aware of that as well. And you can see when managers raise cash. You can see when your value managers are tilting into growth names. You can see when your global managers are taking down emerging markets or moving into China. And so those are all timing the market, and it's happening in your endowment, even though I'm not doing it in my seat as much as others at the table might be doing it. I think big challenges today then is one I'd like to highlight for the group is liquidity. I think that given my payout, I have to think about the health of the college. And in a time of crisis, what am I going to tap? Historically, we've had the fixed income markets to be that store of wealth, the low vol, very liquid. I can go there to fund the college, and also I can go there to take advantage of market dislocations. I don't have that tool today. And so that's been the biggest challenge for me is thinking, where am I going to store that liquidity? What I've sort of chosen to do is hold a little more cash than normal. And our target is 5% cash. And so I'm talking about 8% cash, which a lot of endowments hold much more cash than that. And I have zero fixed income in my portfolio. So it gives you a sense of the risk profile of the college versus peers. But making sure that I have at least 2 years to fund the college, keep the lights on. In a downturn, more students need financial aid. And so what we've found at Hamilton is in downturns, I actually have to pay out more than I usually do. So making sure that I can keep the lights on, keep students in school, keep the teachers there. So I'd say today I have a little bit more cash than normal, but also because I don't have that fixed income lever, trying to find things that can almost bridge the gap. And so I've been focusing a lot on sort of absolute return, non-correlated strategies that while they might not have the liquidity profile of fixed income, I feel like I can get there somehow. So I've taken out a line of credit that can sustain the college for a year or bridge me to capital. If I have a manager that says we don't give daily liquidity, but we give quarterly, knowing I can get to the money in a quarter and bridging that gap with the line of credit, that's become sort of an important tool for us that helps me sleep better at night. And we discussed this as well, making sure it's guaranteed. That was not the case, I'd say, in sort of 08, 09, when people thought they had credit lines and they weren't there. So we spent a lot of time making sure that that's guaranteed. And I'm using that to help my absolute return portfolio provide me with liquidity, like a historic fixed income portfolio would. So spending a lot of time, I'd say, on the non-correlated absolute return part of the endowment, given our high risk profile. There's continuous debate on value versus growth. Endowments historically are value oriented. I came from a very venture heavy, more growth oriented endowment out in the Bay Area to an endowment that was very value oriented. And so we have actually moved a little bit more into growth land, but we're still predominantly a value constructed endowment, but spent a lot of time on that value growth debate. And I do have sort of, I guess, strong opinions there on managers and how they're tackling that today, which we can come back to if that is of interest to people. We have made sure, I think 2 things I believe in, and this is something I've built in over the past 3 years. I'm a very strong believer in innovation. I think an endowment needs innovation. And that probably came from 15 years in the Bay Area, but getting tech in the endowment, it's hard because with venture capital today, access is the name of the game. And if you don't have access, there's no public market substitute for venture. And so I've spent a lot of time getting venture into the endowment and also putting in tech from the public markets. I've also done, I think every endowment needs China. And I know that we're in the middle of a, trade war, tiff, whatever. But I think long term, you need China. And I'd say we're doing a little bit more in real assets today, just that sort of thinking about inflation protection. And I would agree with the sort of 100-year bull market comment. We're long-term bullish. And with that, I'd say making sure we have enough liquidity to keep the college running and make sure that we don't have, if the pool is there to tap, the liquidity's there, the remainder of the endowment, don't transact, and I'd say rebalance into a downturn, and sort of keep that risk level there and construct your portfolio with the long-term outlook of, I'd say equity bias. We like China, we like tech, we like active management. We're comfortable being concentrated and willing to take volatility in that part of the portfolio because we know we have sort of the cash and liquidity set aside. So maybe more aggressive in what is actually invested in the markets, but then keeping a little bit of a cash buffer so that we do not have to transact when markets go down.
Thanks, Ann. Fascinating. When you interact with your committee, are you expecting them to come up with ideas and access to new managers and be involved in some of the thinking that you're talking about here? Or is this more of a staff-driven process?
It's an interesting question because prior to my joining the college, the endowment was really investment committee driven. And I'm the first CIO that has discretion over the portfolio. And when they made the choice to bring on a CIO, I think what they said was, we want to let go of manager selection. We don't want to be in the weeds. We want to elevate the conversation to be more strategic in nature. And so we do not discuss managers at the committee level. We only discuss sort of asset allocation and strategically how are we positioned from a risk perspective. And I think that's the best way to do it, in that if you believe that your long-term asset allocation is the main driver of return, let's spend our time talking there, and let's sort of not touch on the security selection aspect or the manager selection aspect as much.
Thanks.
Yeah.
Ellen.
Okay, so I think that Chris has done a great job of, I don't know, scaring us to death, or talking about like these crazy global complexities that we have to be thinking about today. And then Anne, I think, has done a really nice job of outlining the challenges that we face as perpetual endowed institutions that are trying to accomplish something that's very, very difficult, which is to maintain purchasing power net of spending. So I thought, given that you've got their backdrops, I thought I'll talk a little bit about asset allocation and, a little more, let's get into the nitty gritty here. Like, what are we really talking about? Before I do that, I just want to highlight a little bit more about what I am doing today at my firm, Edge Hill Endowment Partners, because when John introduced me, as you heard, I have spent my career in endowment management. And today, while our firm is what's known as an outsourced chief investment officer, or OCIO, we work only on behalf of perpetually endowed institutions, and we also have discretion over manager selection. So I'm, doing a lot of what Anne is doing, in the sense that our committees, we work with our investment committees of each client to determine the investment policy statement, which is their role as fiduciary to outline the asset allocation and the risk parameters that they are willing to work within. And then within those guidelines, we pick the managers within each asset class. So I just want to go back to what John said at the very beginning, because John, first you defined, a very rigid definition of a policy portfolio, which is that you figure out, okay, I want X% in global equities and Y% in hedge funds and Z% in private assets, and another percentage, or maybe the residual, is in cash and fixed income. we do have very equity-oriented portfolios because otherwise we won't be able to achieve this objective that we're trying to accomplish. And so, Anne, I thought it was fascinating that you essentially have 95 to 92% of your portfolio in risk assets. Yeah. I mean, that really is a lot. So I bring up the policy portfolio because actually I'm a big believer in a policy portfolio. I think that it provides a structure and a framework for a perpetual institution to keep us it defines the guardrails. And so it takes some of the emotion out of investing. It helps you rebalance. I think of the policy portfolio as a framework that if I had to just go away for 10 years, I think the policy portfolio of the endowments with which I'm working on, their policy portfolios should give them a reasonable probability of achieving the financial objective of maintaining purchasing power net of spending. And I say a reasonable probability because, when you do these stochastic modeling and Monte Carlo simulations and all that, I mean, when you think about these two standard deviations from the mean of an 8% expected nominal equity return, over the last, since 1926 or whatever Roger Ibbotson's chart says, you think, okay, 8%, that's great. But the standard deviation of equities is about 16%. So 2 standard deviations is 32. So that's a pretty wide bell curve. And, we are, so the second thing that, John, you said is that you quoted David Swenson about having an equity orientation, but also a very powerfully diversified portfolio, because we have to construct a portfolio, the asset allocation, and then the managers within each asset class such that, Chris, all of the market conditions that you talked about a 100-year bull market, but then we had the global financial crisis. Interest rates might go up to 6%, but they've also been at 0. So we have to have the diversification in our portfolio to really weather all of these conditions. And, you're never going to get it exactly right. And some parts of your portfolio are going to be doing well, and some are going to be doing poorly. But when you kind of put it all together, we hope that we can support the spending that our institutions require to be excellent and to hire the best faculty in the world and to make grants that serve their mission. A huge contrast to the policy portfolio is what Seth Alexander is doing at MIT. And, it's very interesting because he said, and I suggest that you get on their website and read their, letter, their annual letter, and sort of how they view their job and their role as investors, protecting and enhancing the financial assets of MIT. But he said, my skill set is manager selection. And so we're just going to go, my team is going to go out, we're going to pick managers. I'm not going to worry about asset allocation, but I think we've got enough sourcing from different types of managers, strategies, and geographies from all over the world that I'm just going to kind of let it all filter up, and I'm going to see what I have at the end of the day. Now, that is like a totally opposite perspective. I don't know what MIT's asset allocation looks like today, but I do know that they have been one of the top performing endowments. And so I think one of the tensions one of the questions that you always get is asset allocation more important, or is manager selection more important? And is market timing, is that rebalancing? Is that just something that's very disciplined that we do, or is it market timing, which is kind of the that's a bad word in endowment, the endowment universe. John, you said something about how my overweight to emerging markets allowed Carnegie Corporation's portfolio to outperform. And it is true that we were overweight emerging markets in our portfolio. We did have bands around each target allocation. So I was overweight, but I was overweight because emerging markets were really, really inexpensive at that time. And so my thinking was not to make a market call or a market timing call, but it was really to, make a valuation call and to weight the portfolio to more compellingly valued securities or markets. And so that was my thought process in terms of doing that. So we all have primarily a portfolio of primarily risk assets. And, if you look at, say, the Nakubo results, most institutions have maybe 40 or 50% in global equities. But you have extremes. Yale University has, I think, 14% in global equities, public equities. However, they have 60% in private equity strategies, broadly defined. They have, buyouts, they have a lot of venture, they have private real estate, they have private energy. And those categories together comprise 60% of their portfolio, which is also completely illiquid. Now, not everybody can do that, but if you add, I always think about the total equity exposure in a portfolio as the public plus the private. So we're a little more vanilla at Edge Hill. So, our clients have about 40% in global equities. They have 20 or 25% in private equities. Well, that adds up to 65%. 2/3 of our portfolio has, the engine of equities driving these returns. And I want the privates, I want to get paid for the illiquidity that I am bearing. And I want the private portfolio to, I think, probably exceed public returns over a market cycle of at least 300 basis points. I think that is an appropriate risk premium net of fees. So that's kind of how I'm thinking about equities. So then what's left over? So this amorphous category called hedge funds. And hedge funds, as we all know, it's not really an asset class. It's a collection. I think about it as a collection of diversifying strategies that, when you put them all together, provide some powerful diversification to the endowment that I hope will generate equity-like returns over a market cycle, and that are going to be somewhat less correlated with overall equities. And Anne, you were talking a little bit about how you're trying to find more uncorrelated strategies because, in an environment when everything's been going up, to your point with the 100-year bull market or the post-financial crisis bull market, the hedge funds, I would say, is the most challenging or maybe disappointing area of a portfolio. Because obviously returns, when you have managers who are shorting securities and the market keeps going up, it is very, very difficult to add value on the short side, and it has typically detracted from value. So will it add value? Is this the time to throw in the towel? We think that given where equity valuations are in the cycle today, that we do want to stick to a hedge fund allocation, but continue to try to find managers that are going to be a little less correlated, but yet can generate an equity-like return. Because if you are trying to maintain purchasing power net of spending, you've got that 8% nominal bogey. If you have 20 or 25% allocated to a category called hedge funds, you can't have it lag. A 5% return just doesn't cut it. It's not going to allow you to achieve your financial objective, especially if you have maybe 10% in fixed income and cash, which we all know today is returning about 2%. You have got to have that 90% of the risk assets working really hard for you. And especially given the low interest rate environment, the 90% has to do 100% of the work today. So that we really have to take, hopefully, very thoughtful risks, stick to our asset allocation, and then Anne's job and my job is to find managers that we hope will outperform their respective benchmarks and add value. I do like one advantage of the policy portfolio is that it has certainly helped me stay relatively fully invested through this bull market. When markets keep going up and up and up and valuations are, reasonably high, they're at the high end of the range. There is this tendency to trim your portfolio, to have a little more cash. And I'd say the policy portfolio and having a target has allowed us to rebalance. So as the equity markets rise, we trim a little bit of equity and, reinvest it back into the entire portfolio. But it has kept us, it's saved us from ourselves in the sense that we have maintained exposure to the equity markets during this bull run. So, Chris, you talked about, there might be a downturn. And Anne talked a little bit about a potential downturn. I would actually love a downturn because, as a perpetual investor, when markets valuations decline, it gives you the opportunity to buy assets that are much less expensive. I think the key to success, though, in executing a successful rebalancing strategy, let's call it that, during a market downturn, is having strong, thoughtful governance of your institution. And I cannot overemphasize how important the governance of an institution is, because everyone in this room has heard people say that they are a long-term investor, but the minute they start losing money or the strategies in their portfolio are out of favor, they want to fire the manager, they're seeing what's wrong. And I know that Anne, that the trustee body at Hamilton just has a superb group of people on their investment committee. And I think our client base, one of the reasons that we've probably chosen to work together is that they do have strong governance. They really, really get it. And so, one of the challenges today, as Anne mentioned, is that, I'm a value girl. Like, my background and training is as a value investor. That's the David Swenson motto and, the Ben Graham philosophy. And value really hasn't been working. But I think that certainly our trustees that we have serving on the investment committees of our clients and Anne's trustees, they really understand that, sometimes you just have to wait. And if you are a long-term investor, hopefully you can wait. Mean reversion is very powerful. I know a lot of us are thinking about the whole technology sector and this new winner-take-all phenomenon, and is that disrupting maybe this mean reversion or value model? So I think we have to always have humility and think about, what might be different, although usually when you ask that question, you're doing it at the absolute worst possible time. So let's see. I just want to make a comment about real assets and the role of real assets in the portfolio: real estate, commodities, tips, all these categories that are considered to be, I think, the common conventional wisdom is that these assets provide you with some measure of protection against inflation, and especially unanticipated inflation. And I have to say that I challenge that conventional wisdom. I think that there may be correlation. I'm not sure there's causality. I think that when you see commodity prices rising, that typically is correlated with global growth. So that emerging markets might be just as good a proxy for commodities as, and certainly in a growth environment. It's hard to have enough of these assets to really protect you from inflation in any case. And I think we all know that over the long term, public equities or just equity exposure is the best protection against inflation, even though over a short term you might get a hiccup or two. So I'm a believer in having real assets in the portfolio as part of a return enhancing strategy, especially if they were private investments. I'm not a believer in having a passive commodity allocation as a diversifier, because for the last, 20 or 25 years, it has proved to have a massive opportunity cost in a portfolio where, we do need to generate strong returns. So why don't I wrap it up? And because I'm sure there are going to be a lot of questions.
Thanks, Ellen. One question for you. In your work, you're working on a discretionary basis by definition, but how is your interaction with your various client committees managed from your end?
Mm-hmm. So I think that when you have discretion, whether you're the chief investment officer at the institution or we are the outsourced chief investment officer, I think the role of the investment committee is to evaluate your performance and whether you're doing a good job. So both Ann and I have to give our investment committees enough information about our thought process and our decision making so that they are able to evaluate whether we're doing a good job and whether our performance is appropriate over a market cycle. So we're extremely transparent. We want them to know everything that we share everything with them because we want them to understand who we are, what our philosophy is, how we're implementing it, what kind of decisions we're making on their behalf. So we share every investment memo when we hire a manager. We send the committee our investment memo because we want them to know about it. We want them to ask questions. And I'm sure, Ann, you probably do the same thing because, they need to know. Because especially when you're in those tough situations, that's when the rubber meets the road, and patience is always required.
Great, thanks. So let's open it up for the audience for questions. Yes.
Just interested in the panel's view on international markets now and emerging markets. You mentioned that Ellen predicted the last return evaluations seem to be a little bit cheaper.
So I mentioned we get a lot of emails a day. So the biggest email I'm getting right now is, why in the world do you even have emerging markets in your models? And, you go through the whole explanation, but you realize that you kind of have to know you really need to know who you're talking to, because just to put it into context, there's $2.5 trillion at our institution. About $900 billion is in firm discretion. The other $1.6 trillion could be in brokerage or whatever. So what I have purview on is, generally speaking, the $900 billion. We have all these different models, and Ann and Ellen said it really well. We have long-term endowment models. They get it. They understand. Where are you in the cycle is what they're asking us. How much is it time to add a little bit? Do you rebalance? Do you do all this stuff? The shorter-term models are, I often find that it is a U.S. biased investor. That's fine. probably benchmarked against the S&P, wrong thing to do, and is looking to beat the S&P. Now, that's a whole nother discussion that we could have at another time, because if you're looking to beat the S&P, just have a tax-advantaged account where you own a good enough securities in the S&P, and you build a little bit around it, and you have a tracking year of 2% or something like that, and you beat the S&P by going down in cap or expressing more growth versus value. You don't hunt around the world to try to beat the S&P. But having said all that, we have about a 68, 70% tilt to the U.S., 30% outside the U.S., half of which, about 40% of which is emerging markets, and the balance is non-U.S. We're neutral, international, overweight emerging markets because of what Ellen said before. You're talking about a 40% historical discount. Now, I am not a huge believer that valuation will tell you when to buy or when to sell at that point in moment, but it'll certainly give you a lot of clues over the course of the business cycle. So right now, for those who are not allocated to emerging markets, be buying them, and we'd be adding to them. We're pretty much fully invested in a lot of our models as well. So for the fully invested models, we're taking our cash and adding to the exposure. Non-U.S., Europe is in a totally different part of the cycle. They have not cleaned their balance sheets. They have not gotten rid, or on the other side of the credit cycle, their central bank bought corporate bonds. Japan bought equity. ECB bought corporate bonds. If there is an inflation issue, they will have to sell bonds that are corporate bonds, which widens the spread, pushes yields up at the same time, deteriorates the balance sheet. I think Europe is in a lot of trouble over the course of the next 10 years, but they're being held up right now by very high accommodation. So at best, a neutral allocation to international. It does offer diversification benefits. Emerging markets at an extreme value right now, and for the patient investor, it's one of the better investments one can make right now.
Okay, another question? Yes.
Some interesting comments on inflation from Emily. I wonder whether, or Ellen, excuse me. I wonder whether Ann and Chris have any comments on inflation protection, direct focus on investments for inflation protection as opposed to a high return for the portfolio to offset it.
In the Hamilton endowment right now, we have about 5% in real assets, and that's inclusive of real estate and natural resources. And so if you compared us to peers, we are very low. I think that reflects, again, a long-term bullish nature of the trustees of the college and wanting to take on equity risk, and to get to that high hurdle, realizing that if we put more into an asset class like real assets, where if you look at capital market assumptions, the return is lower than equities. If you say equities return, say 6.5% over a cycle with about 22 to 20% vol, we think we get less than that from real assets with about 17% vol. And so there is a bit of drag on the portfolio from holding those assets for inflation protection, when we do believe in the long term equities will get us there and will protect us from inflation in the long term. So we have a very low allocation to real assets right now. We have done a little bit more in real assets lately. And where that comes from is trying to find uncorrelated strategies. And so I'd say the most recent real assets investment we made, it was more of a blend, I'd say, of absolute return credit and real estate. And actually, I think, Ellen, you may be in this one as well. Right. It's a fund that invests, they basically buy defaulted commercial real estate mortgages, so first lien. And we think that you do have that sort of real asset protection if you need to take ownership. But otherwise, it gives you sort of great absolute return generation and that current income component. And so I think when we look at real assets, we're doing more blends like that, where it's not purely for inflation protection, but gives us some return, gives us some diversification into more of a non-correlated asset.
So, Anne, I just want to say, it's so funny because a bunch of institutions, I think, did invest with this one strategy, and some people put it into their real estate bucket, and some people put it in their hedge fund bucket. So I put it in my hedge fund bucket, but I think Anne put it in her
Wherever you have a gap.
her real estate bucket. No, it's not about the gap. Like, I just looked at it as the uncorrelated nature of the returns, I thought, caused it to be more of a hedge fund. That's what I'm trying to accomplish there. But because it's backed by this real estate, some people.
Right.
So anyway, so it's, as Ann said, it's an art, not a science, for sure.
I'm, to add to that, I'm quickly just a big believer in the most powerful investment one can make is a convergence of three things. And hit it square in the head, which is return potential, compound potential, and at the same time, some benefit of uncorrelation or non-correlation. And when you think about inflation protection, what it was is not what it is, or what it will be. Because inflation protection dominated in the 80s, absolutely dominated. The single greatest asset one could have owned from the 80s all the way through the 1990s was not an internet stock or land. It was Mexican CETES, short-dated paper, or zero coupon bonds. So you think about that, that is not the case, even if inflation comes. But I totally agree with Ann and Ellen, which is, if you can go to triple net leases, you could do a whole bunch of fancy things, but just keep it simple. Timber, number one. Capital gains treated. We have a housing shortage in the United States. We have a housing shortage around the world. Wood and sawmills, there's 50% less sawmills than there were before the global financial crisis, so lumber prices have a natural put in them. And at the same time, the amount of people who are trying to buy timber right now is ridiculously high demand. And those who have it are holding on to it. If you can find timberland, which we actually are estimating a 12 to 18 month roll right now before you can actually put the capital to work. Timberland is one of the better investments. Housing in general, I do believe is one of the better investments over the cycle. And then last but not least, just simply looking at what drives good old powerful compounded returns. It's a convergence of private assets with what the question was all about. So any energy infrastructure assets one could accumulate, particularly in areas that are around ports, are extremely valuable and have a natural tendency to rise, not only with inflation, but also with the demand that you're seeing around the world. So that's how I would look at it.
Okay, we had a question over here. Still there? Yeah.
And you mentioned
Ryan.
the need to get technology in China into the portfolio, which I think that was very interesting. Can you just give us a framework or a little bit more detail on how you went about that and how you guys?
Right. I think part of that came from my background, where I spent over a decade with an endowment that had an extreme allocation to venture, and I'd say half of my time was spent on venture sitting in the Bay Area. And as those assets grew through time, it was very powerful for the endowment of the James Irvine Foundation. It more than doubled the endowment. And the endowment is where it is today simply because of our venture investing. And so I'm a believer in it because I saw it happen. And then when I came to Hamilton, when I joined at Hamilton, it was a long-only equity portfolio with no venture. The long-only equity was very value-oriented. And the bet was on equities, but just very, very, I'd say, diversified with a value orientation. And when I did a holdings-based analysis across the portfolio, it was fascinating to me because while at the manager level, it looked like we were lining up with ACWI, and it looked like we had sort of benchmark tech exposure, when you went down to holdings level, we were actually underweight tech. And I thought, this is so the extreme of where I came from, where I saw the transformative power of innovation for the endowment that and it's also that value orientation I have. If it's not there and you think it's valuable, put it in. And because of that, it's been hard to get the money in the ground with the venture managers. I do think size is my advantage at Hamilton. I can take a small piece of a venture fund. I'm happy to take 1 million. That moves the needle for me. And I've also found that when I tell venture funds, I will take anything. If it's 500, if it's 1 million, give it to me. It's interesting, they come to you and they say, okay, we think we can find you one. I have had this happen 3 times in the past 2 years, where I get the phone call after I've sent in my docs signed, and they say, you know what, we found another one. We found another 2 for you. And if I hadn't been so open and flexible to say, I'll take whatever, it wouldn't have happened. I think some endowments say, my minimum is 10. If you can't give me 10, I just can't play. So I'm willing to play, and I'm willing to play for small pieces. And I think that's one thing I've done at Hamilton. And so, yes, that means more managers in the portfolio, and I like a concentrated roster. There's only one of me, and I have a very small team, but I do think in venture, if I'm going to have sort of manager proliferation, I'm okay doing it in venture with the end goal that once you get your foot in the door, you just need to get your foot in the door, and then you work on them the next 3 years or 2 years until they raise again. You work on them. And you can grow those allocations. And we did that at Irvine very well, just constantly knocking on their door, constantly, I'm in town, can we grab a coffee? I'm trying to build rapport and relationships. And you can see that it will grow through time. The access will grow through time. But it is slow going. And so while I've been allocating to venture, it takes time to draw that into the portfolio. And so while I'm waiting for that to mature, I have been comfortable making more concentrated tech bets in the public portfolio. Because like Ellen, I look at public and private equity together. That's true equity exposure for me. And so while it's slow going on the private side, just getting it to work, I am making up for it on the public side. And so I'm lucky that on my investment committee, I do have a long-short tech manager who runs a very highly regarded fund in Boston. And so this was probably 1.5 years ago. We had a powwow where we sat down and I said, you're the expert here. If I can't play with you, who do you think are the best ones out there, and who should I play with? Again, access is involved with public managers, especially on the long-short side. But I came up with a couple of ETFs that I thought did the job as placeholders until I could get the active manager in that slot. And those ETFs, which I funded from S&P 500 exposure, have widely outperformed the S&P 500. And so again, that's more of a placeholder until I can get the private side working for me. But it's helped us so far. And that really came from just having a strong belief that, I believe in innovation. I believe in humanity. Humanity goes on sale every 10 years, they say that, right? Bet on humanity. I believe in innovation in this country. I believe in innovation in China, which is also part of my China bet. I just think you can't bet against China and how innovative they are and the demographics of the country. The growth of the country, where valuations are in China. It's a value play right now, but part of my China bet also is tech.
Other questions? Yeah, Kurt.
And for just one more, I appreciate your asset allocation discussion. In the context of that, and I know you don't look closely at some of the macro things, but there are a couple of maybe serious political disruptions on the horizon here that wonder if you do or should, or how you would factor those in. So Chris, you mentioned Europe. There's a lot of things going on there. There's another election. There's another talk about the risk of a credit default there. We have Brexit. And here we have a blue wave midterm, and that impacts some of the Trump agenda on taxes and repatriation and so forth. There are those concerns that you would want to, do you take those into account for asset allocation?
Yeah, we do. We do for sure. Our committee meets monthly. We talk daily, but we meet monthly. And the geopolitical equation has always been, probably not the right phrase, but an overlay to one's process. You kind of have to know what's going on. You have to know the big shock that's out there rather than the slow numbness that happens with geopolitical equation. In many respects, the outside non-U.S. geopolitical equation is a lot calmer now than we have seen in the last 10 years. Brexit, Theresa May has said it's going to happen by March. There is a call for another referendum, but it's probably not going to happen. The growth curve in the UK so far has actually gone up versus the announcement. We'll see what happens after that, but it seems like if you just pick that one, you'll see some sort of an agreement around most parts of trade and free movement. We're probably not going to hear it that way, though. The big issue in Europe is the Italian situation, for sure. What the new budget looks like will probably be above the targets that the EU have set. If that's the case, that's a domino effect for the other countries that may look good now, but probably won't in a few years. Europe's growth curve is going to be hurt because of that. The banking system in Europe has a lot of bonds on their balance sheet that they're not marked to market. And as Ann said before, and Ellen said before, I'm guessing that manager can't wait for that to happen so they could buy those deteriorated bonds or loans. And then last but not least here, if there's a full blue wave, and it's not just the House, but it's also the Senate, there, obviously, you got to talk about impeachment, impeachment proceedings, I should say, as being a shock. And everybody says, well, maybe we'll get some gridlock, and gridlock's good. That's not necessarily true. Because the next part of the cycle, after this one wears off a little bit, has to be infrastructure related. And if you can't get an infrastructure related bill, particularly private, public, then your growth curve, which is 3-4% right now, goes right back to 2. So that's an issue. The smart or non-smart folks are suggesting that it's the Senate right now, that it's the House that falls and the Senate stays. If that's the case, the widening deficit stops, tax reform 2.0 doesn't happen, and the markets will like that. At least that's our view.
Okay, I think we're just about out of time. I'll turn it back over to Steve.
Thanks, John. So a couple of housekeeping notes. Excuse me. So Phil Zecker, our chairman of the programming committee, is asked me to ask you on your comment cards, in addition to letting us know how the speakers did, if you would put any suggestions for 2019 on the cards. S'il vous plaît. The Board of Trustees will be meeting here right after the session, so hang around, don't go home. And, just as a final word, it's very gratifying sitting here. Our mission is to educate investors, and I'm sitting next to two of the preeminent people who have sat here, not just in this room, but in other rooms, and have weighed in for the investor. And I just want to thank Bill Jarvis, who sponsored today's session, but also hopefully will carry the torch. And Bill, would you like to say anything?
Well, I couldn't be more delighted to be here, and I couldn't be more delighted to be here with our CIO, Chris. As many of you know, John and I were colleagues at the Common Fund for a decade. I'm now at U.S. Trust, still doing the same work for the same people. So you'll see more of us, and we hope to be able to sponsor more of these in the future.
Great. Thank you, Bill. And we do appreciate that. And again, I want to say, Ann, Chris, Ellen, good job. Thank you very much.